Hi, this is Mark from Right Line Trading. I just wanted to go over some indicators real quick, give you some tips, and show you some of the real difficulties that traders have in using some of the standard indicators and the standard indicator analysis that they're faced with today. Now, the first one I wanted to review was a real popular one, and it's the oscillator. The oscillator formula simply looks at the ratio on a long move between the close of the candle and the high of the candle, and then a short move, the ratio being between the close of the candle and the low of the candle. Now, as the low approaches the close, the oscillator line moves down. And as the high approaches the close, the oscillator line moves up. Now, we all know that the market can stay oversold or overbought for a considerable period of time, and oscillator signals can be real difficult to trade. In fact, impossible to trade. Now, whoops. Let me drag this down here. Oh, here's what I did. Excuse me. Now let's take a look at this signal right here. Now here's an oscillator cross to the downside right here, and a short trade, a short signal. But look what happens to price. The price continues to rise for a while. You have to have a big stop. We can both look at this signal right here. Here's a cross to the downside. Short trade. Price rises for a considerable period of time. This is an 8-range chart. You need a 25-tick stop to get this market to turn. It's not going to happen. Look at this signal right here. Now, I'm showing you the CCI. There's a short trade on the crossover. Price simply continues to rise, flattens out, and then goes up. Now, with that kind of predictive value, this indicator is going to give you big problems. A lot of people use it, some not as a primary indicator to trigger a trade, but many to help with trading precision. And you can see when the indicator signals are so poor and the predictive value of an entry trigger so bad, all it's going to do is bleed money from your account. And this is the reason why so many day traders and swing traders go broke. Now, there's a big thing about looking at different oscillators, the CCI, Williams R, fast stochastic, slow stochastic, and tweaking the inputs. And I can tell you, it makes absolutely no difference. The indicator analysis is flawed, and it's going to be flawed no matter what you do. Here is Williams R. You have the same problem. You get a crossover right here. Signaling a short trade. The price just goes right up. And you're going to get winners. The problem is pulling in all the losers. There's a short signal on a crossover. It's an overbought crossover back to the downside. Price flattens out, just like on the chart we saw before, and goes straight up. Now, if we look and compare both charts with Williams R and the CCI, you'll see that they're both pretty similar. There's a move up. There's a big move down, but then a move up. They trace out similar lines. Now, I don't think I'm looking at the same time frame. Let me move the chart to the right edge. Here and here. And let's look at both charts together. Here's our CCI right here, and here is our. You can look here and you can see that they are very similar. There's a move up, and they're tracing out similar lines. The formula that's used to look at the numerical ratio between the high of a move and a close and the low of a move and a close are just slightly different. But the predictive value of a trading entry on all of these is equally as bad. Doesn't matter whether you use the Williams R, the CCI, fast stochastic, or slow stochastic. The other problem is that price drives this indicator. The indicator doesn't drive price. When price moves up, the indicator moves up. When price goes down, the indicator falls. So when price drives the indicator and the indicator doesn't drive price, the predictive value of a trading signal is exceedingly poor. And it's not an indicator you want to use because its precision in calling a trade entry is so bad. Now let's take a look at the MACD. MACD is similar. It's a very elegant indicator. But if we trade MACD cross on, I'm using Apple again. I wanted to use the same financial instrument every time. If you look at calling a signal off a MACD, you can see that we're going to get winners, but we're going to have lots and lots of problems. And the problem with the MACD is that it oftentimes calls entries very late. If you look right here, now you're going to get winners, but you're going to pull in an enormous amount of losers. Now right here, trade is calling for a long trade. Just never happens. Price falls. Right here, you don't get the short signal cross until the move is well in progress. Now, tweaking the MACD inputs, making it faster, it's not going to help you. And again, you're always going to get a MACD crossover to the downside when price is driven to the downside by other forces. You're always going to get a MACD crossover to the upside. And here's another bad signal. Across to the upside, right here. That essentially goes nowhere. Now it goes sideways, and eventually it goes up. It depending on the size of your stop. I don't take more than a candle stop. This would have taken me out. This short trade or cross here occurs very late in the move. Here's the top. And what you're getting is only a tiny piece of the end of the move. Ultimately, the indicator is driven by price. It should be the other way around. Price should be driven by the indicator. Now, if we look at Fibonacci, Fibonacci is absolutely a major hoax. Fibonacci was an 11th century mathematician who created Fibonacci transformations, and from those transformations developed Fibonacci numbers. Now, Fibonacci numbers are really, really cool. They describe quite a few things in nature, and they do have symmetry. And if you look on YouTube, they're really cool YouTube videos as to all the different things you can play with when you use Fibonacci numbers. But to think that Fibonacci numbers developed in the 11th century were somehow going to determine the movement of price on a financial instrument essentially 800 years later is absurd. We have looked at Fibonacci on 2 years of market replay data, and it's ridiculous. Now, this is the low, came back to the low, but it goes right through the high. Now Fibonacci enthusiasts can always create a scenario that looks like it works, and it's always done in retrospect. But if you trade off of Fibonacci resistance to the downside, or you trade off of Fibonacci support to the upside, you're just going to get loser after loser after loser. And whether or not a Fibonacci area of support or resistance holds is really totally up in the air. The predictive value of taking a trade using Fibonacci is exceedingly poor. Fibonacci has been in use for at least 2 decades, and it's made nobody money. Now let's take a look at the indicator called the cash metrics indicator. This is being sent to you who are in the webinar, and I want to show you its value. Now this is it right here. It evaluates 16 internal cash metrics on the market that you're looking at. Now here's a 13-range Apple chart. It's the same instrument we were looking at with the other indicators. And it's the cash metrics indicator for the NASDAQ. So it's looking at NASDAQ internals. And what you're looking for is an alignment of the fast cash line, which is the top line, with the lower line. When they aren't aligned, the best thing to do is to stay away from trading Apple. When they do align, you almost always get a great trade. And remember, this indicator analysis is not looking at price on the trading chart. It has nothing to do with price on your trading chart. It doesn't have any idea what price is doing on this chart. So price is driven by the indicator. The indicator is not driven by price. So let's take a look. We wait for the alignment. Now here is a short alignment, right here. Get this move up. I didn't put in any moving averages, nothing to provide this chart with market structure, just the indicator. All the internals, all 16, aligned to the downside, right here. Get a great short trade. On 15 cents of risk, we make 44 cents. So if you could trade 1,000 shares, you make $440 on $150 of risk. If you trade 200 shares, you make $88 on very little risk. Looking for a short trade? Right here, dual red. You want to take it off of a retracement up. You go short right here, 31 cents. You're now at 70 cents. Alignment again, right here. Now you could also take this trade short as well. I didn't even count that. Even though it's a small trade, it's a winner. And right here, you get another 34 cents. So now you're up to $1. If you trade 100 shares, you made $100. 200 shares, $200. 300 shares, $300. And the specificity of the signal, which has nothing to do with price on your trading chart, makes a winner extremely likely. This is an extremely low-risk, high-reward trade. And I could go through this for days, and you can see the same thing. And we're going to go through 2 days. Now, this is last Thursday. I'm going to show you last Friday. Now, we wait for the dual alignment. We don't want to trade when all the individual metrics on this indicator don't align. And there you get it, right here. There's your long signal. Up you go, 57 cents. Now you're up about 50. And remember, on dual signals, there has not been a loser. Here's another one. Red, red. It's a small winner. It's the move up. You take the roll back to the downside for 24 cents. So you make about $1.60, $1.70 without a loser. Now, if you trade 1,000 shares, you're up $1,700 or $1,800. 100 shares, you're up $170, $180. 200 shares, you're up $350, $360. The key is these are very specific entries that provide you with very low risk and very high reward. Now, the next day, remember I talked to you about trading the open. Here's the open. Apple has a tremendous gap to the downside. Once the open occurs, the institutional players come on board and they decide the future direction of the market. You have a move up, take it short, 38 cents. A move up, you take it short, 28 cents. A move up, you take it short, 22 cents. Now the market loses the dual signal. Both the fast cash and slow cash don't align, and you can see what happens to the market. You do have this short bias based on the slow cash line, and you could trade short, but you're trading short with more risk. If you want to trade it short, you can. If you do, you get multiple rolls to the downside, but I'm only looking at the lowest risk trades where there's dual alignment. Now you get red, and the market is just a mess. You stay away from it. You get a little long bias, but you don't trade one line. Now right here, you're on a red slow cash line and bulls are trying to push the market up. You're going to stay away because you know eventually you're going to get a fall. Even though this is a high risk entry on on the slow cash line, you're simply not going to take it. We're going to look for the best prime entries. And here we get red, short trade, 33 cents. Here we get red. We're only going to trade the best trades. And we take the short off a pull up or a retracement up and roll to the downside on dual red. Now that's a nice move. We just can't trade. We're not going to get every move. Here's a perfect short right here. We just can't trade this whole move. We get the move right here for 32 cents. Now here's our primo trade of the day, right here. Get our big roll down. That's occurring at the end on a fast cash and slow cash green line. The first move up, that's a piercing candle, and you get 89 cents on that trade. That's $890 on 1,000 shares. 89 on 100, about 180 on 200. Now the thing is, what's important about this is that you wait for the dual signal, you take the trade on the candle close, and the probability of getting a loser is so low. You're about a 90% positive predictive value on the trade. And you can trade anything on this indicator analysis. And this indicator, the key is, it doesn't look at price. It drives price. When it's red, you know that market internals are going to pull price to the downside. So it has a tremendously powerful predictive value for a winning entry. And it is not difficult to trade. It has tremendous predictive power in the sense of telling you where price is going to move out into the future, and is unlike other indicator analysis. But just wanted to give you the benefit of giving you a run-through of 2 days of trades on one financial instrument to show you how many great entries you get. It makes no difference how many shares you trade. This is an expensive stock with a lot of movement, and I wanted to show you this on the stock. But this move is irrelevant to price. On a much cheaper stock, you're going to get moves that accumulate less amount of profit, but you're taking less risk on a cheaper stock, and you can buy more shares. So on a stock that's $10 or $15, you can probably go 1,000 shares. You can still ultimately make the same amount of money. So I hope this has given you some insight into market technicals, in oscillator analysis, in MACD analysis, indicator analysis, technical analysis as a whole. I hope you'll come aboard. We only have 2 slots left, and I just wanted to provide you with this insight. So listen, everyone, have a great evening, and I wish you all the best of luck. Take care all. Bye-bye.